So you bought AMD going into earnings and things didn't turn out so hot. What do you do about that with options if you want to try to recover some of your losses before they report their earnings next time? We're going to talk about that today on Open Interest. Hello everybody and welcome. I'm Mike Coe. Welcome to Open Mike. So AMD reported earnings after the close yesterday and the results were not that great. Actually, their earnings were okay. What got investors a little bit upset is the fact that their guidance was not so exemplary. And of course, as we can see here, the stock is trading substantially lower. In fact, in the overnight session, it traded much lower than this, and had it actually stuck at those lower levels that we saw back, down around $1.07 or so, it probably would have been even more meaningful to discuss the things that we're going to talk about today. But one of the things we're going to talk about is something called a recovery or a repair strategy. These are options overlays that people who hold stock can use so that they can essentially accelerate the gains that they get on a near upside move, and thus potentially recoup some or more, at least, of their losses without the stock recovering back to a level where they may have previously owned it. So the way we look at strategies like this is, of course, you need to own some upside. The whole thesis is that you don't want to sell your stock, but you also don't want to commit additional capital. And you're hoping to get to a break even from your initial entry point that is a little lower by creating a bit of a boost on the near upside. So the way that takes place is generally with the use of a ratio call spread. Now there are repair and recovery strategies that people use for a variety of structures. So we're just going to assume that you're long the stock in this particular example. And we'll just pull up Options Play very quickly to do this because it'll be easy to illustrate. So you're long AMD, and we're just going to put this in as a long stock position over here. So for the sake of argument, let's assume that you own it around $120 or something like that. We'll say that you bought it right before, let's say you bought it yesterday. And your concern is that net of the news that came out, the chances that it recovers back to the price at which you bought it isn't that great. So what you can do is you can actually add an options trade on top of your equity position without laying out a whole lot of capital. And what you would do is you would buy, usually something close to an at-the-money call. And then you're going to sell more than the number of calls that you just bought. So in this example, I might do something like this. So buy one 115 call and sell two 125 calls. I'm spending just over $5 for the 115 call that I'm buying, and I'm collecting 2 1/4 for the 125 calls that I'm selling. And what that ends up doing is it essentially, now in this case I was trying to do this for something close to no premium, and as you can see it's not quite zero premium because I'm going to collect 2 times 2 1/4 for the 2 calls that I'm selling, so that's $4.50, and I spent $5 here, so I'm laying out 73 cents in this case. Kind of a meaningless number in the grand scheme of things, but the benefit of this is that, of course, if the stock gets back up to the call strike that we're short, the 125, from 112 where it is right now, you're going to make $13 on the stock, but then this call spread is also going to be worth $10. So you're going to make $23 in total, right? So in other words, if it gets back to 125, you're going to have a break even that's equivalent to $135. So if you had bought it back, let's see if we can find where it was $135. That would be back around here. So maybe this was, you saw this gap down, not exactly the best time to buy a stock for what it's worth, but maybe you saw this gap down back in early December of last year. You had a limit order, you got hit, maybe it was sitting out there and you got hit on the stock, you owned it at 135, you hoped that earnings might be able to provide a little bit of a boost, and instead you got the result that we saw today, which is that the stock trades down a little over 6%. Well, with this 115-125 call spread, which expires in 44 days, and that's pretty much it's an amount of time rather akin to where the stock gapped down to that 135 level. And you're not really laying out meaningful premium. You might be able to put this thing out for even. So, buy one, sell two, put it on the limit order book, and maybe you'll get this thing on for just about even. And essentially, you're not quite doubling the returns up to 125, but pretty close. So this is, it's one of the most common questions that I would get unsolicited. People would reach out to me and say, oh, I bought this stock. Is there an options strategy I can use, to make my money back? Well, you can't. To say it's a stock recovery strategy or repair strategy, look, money lost is money lost. But you can do things that will increase the amount of money that you make on a partial move back and thus recoup your losses more quickly. And this is one of those strategies. So for those who aren't familiar, this is something that you can think about. Now, there's something else I thought we would talk about, because on Monday, we were talking about options selling strategies. I think we were talking a little bit about Tom Sosnoff. And there are a lot of folks out there who do this. They like to sell premium. And there's a lot of reasons to do that. First of all, it's an investment strategy. When implied volatility gets high, the return profile for selling options premium tends to get a little bit better. The other thing that people like about it is that option selling strategies, implemented correctly, will tend to have higher probabilities of profit per trade. So I thought, in the spirit of looking at AMD, we would also take a look at, well, what if you had put that trade on? If you sell options premium, what's the thing you don't want to have happen? Generally, what you don't want to see happen is you don't want the stock to start moving violently or to gap. And that's precisely what AMD did. But we have also talked about the fact that you get this vol crush effect, where options premiums going into a catalyst such as earnings tend to be elevated. And then once that catalyst comes and goes, a lot of that extrinsic premium tends to come out of it. So, well, right now we're looking at my Bloomberg screen, but we're going to ditch that for now because we're going to use some other applications today. Maybe some people have asked me, oh, what do you use for this? What do you use for that? And as you guys see, I tend to use a Bloomberg terminal quite a lot. But I realize a Bloomberg terminal is not for everybody. It's an expensive piece of kit, and a lot of very good information and very good tools are available at much better prices if you don't need some of the functionality that Bloomberg has that is pretty much for institutional users. So the first thing I thought I would do, and actually one of those things I'm showing right now as it happens, so I have a little bit of an API in here. So this basically I can pull all kinds of things from the Bloomberg and put it into scripts and code and into my Excel sheet here. So that's what I'm going to do right now. We're just going to blow this up a little bit so you can get a better look at it. Okay. So what are we looking at here? So we were talking about selling, month and a half out strangles where both the call and the put that you sell are about a 20 delta. Each are a 20 delta. And I'm talking about the absolute value are a 20 delta. But in effect, the net delta of the strategy is really going to be very close to zero. So what I was looking at in this case, if you look over here, and this is, by the way, you don't have to pay too much attention to the syntax in it. This is just Bloomberg ticker for these respective securities. But what I have here are the prices, the implied volatility, the vega, the delta for a strangle yesterday, before they announced earnings, and that exact same one today. So this is, I'm going to highlight this set first. This is where these options were yesterday. So I'll just highlight these in yellow. So what you're looking at is the 105, 140 strangle. So if you had yesterday, at some point during the day, this is the mid price as of the close, but it would be representative of where you could have sold this strangle. You would have sold the March 105 puts, and the price for those would have been about $2.47. This is as of yesterday. The calls were about $2.62. So on balance, selling both of those, you would have collected a little over $5 a share. Okay, and that's $509 per contract, because each contract, most of the time, barring corporate actions, so that could be stock-related dividends, splits, reverse splits, and things like that. But generally speaking, most listed vanilla options are going to represent 100 shares of the underlying asset. So that would be $509. So you sell that strangle, $509. And the delta on that trade would have been pretty close to flat. The put was a negative 20 delta. Remember, when we say 20 delta, we're thinking in absolute value terms. But when you're thinking about the delta of the trade, you take the quantity that you did and you multiply it by the delta. So if I sell, if I sell one put, that's -1 times negative 20. So that's long 20 deltas. And if I sell one call, that's -1 times 22. That's going to be obviously a negative number. Put those two together, and actually, so the signs on these are the actual signs of the option, assuming that you had bought it, but you get the point. You buy one, it's 1 times that number. You sell one, it's a negative number. So pretty close to flat. And these were the implied volatilities for those respective options as of the close yesterday. So about 50 vol. All right. So then you wake up this morning and you see that the stock has gapped lower, and you're thinking to yourself, uh-oh, that's not what we want. Number one, now you're taking on delta and you're negative gamma. What that means is that if you are net short options, what's going to happen is as the stock declines, your position is going to act longer and longer, the underlying. And as it goes up, it's going to act shorter and shorter, the underlying. So that's negative gamma. Your delta changes in kind of the wrong direction. You can think of it this way. And yet, despite that gap, this is about $1 cheaper today. So if you had sold it, even though the stock moved pretty sharply, you're ahead of the game. Why are you ahead of the game? Well, the answer is found right here. This is the implied volatility of these options as of, actually, I don't know if, did I refresh this? This might be, I'm just going to refresh it really quickly. We'll see. Oh, look at that. It's even more money. Okay, so I hadn't refreshed that information. So in fact, actually, you would have made something close to $140, right? So sell one strangle, you would have made $140 between yesterday's close and today, even though the stock moved fairly sharply. Now, that doesn't mean it's a lock. It most certainly is not a lock. But it does give some window into the benefit that that vol crush can provide when you sell premium going into a catalyst. Which brings me into the next thing, which is, now this, by the way, I can show this in either a light theme or a dark theme. I happen to have it on the light theme. Leave a comment and let me know which one you prefer. So what are we looking at here? This is something I had promised I was going to show a little bit more of. This is unusual whales. And what I like about this is that we can get a lot of this information that I was just talking about and sort of visualize it really quickly. So I'm going to just get rid of this here for a second. So this is the term structure. You often hear me talk about the term structure. This is the implied volatility for all of the respective expirations of options going out in time. Okay? And so this is just what it is as of today's close. The March options expire in about 45 days, so that's going to be, that's 37 DTE, 44. This is March expiration, so you can see if I'm hovering over here, I don't know, maybe I can blow this up a little bit and we can get a better look. See if this makes it a little clearer. There, hopefully that's a little easier to see. So what we're looking at now, this is the March expiration, and you can see that's the bottom number, that IV, is that for 4 numbers after the decimal place. So 40.76 vol is where we're dealing with the at the money options right now for March are as of today. And if you want to see where they were yesterday, now I'll just, oops, there we go. I'm going to overlay that. So this is what happened. This is why those decayed as much as they did. So if we look back and we say, well, how much theta was there? There was not $140 worth of theta in that strangle. What happened was, and we can go right here, once again, there's the March options. Where were they yesterday? So IV2, that's that bottom number that I'm on the thing that I'm highlighting here in the legend, 0.5026, 50.26%. So that's, again, the annualized standard deviation implied by options prices as of yesterday's close and today, 40.76. So what happened? The extrinsic value of the options essentially came in by 20%, all else equal. So even though you got this adverse move in the underlying stock price, you benefited because now that that catalyst has come and gone, that strangle has decayed materially. And I will just quickly point out one other thing, which is that if you were in that trade, you would want to do something about it today. What would you want to do? Well, that depends, right? So one thing you could certainly do or have done is you could just simply take your profits. The other thing you could do is adjust one or both legs of the option to get back to delta neutral, okay? Because this should actually be an inverse because you're actually short this structure. So it's going to be equal to, let's say you're short one of them. So at this point, you're going to be, oops, I'm going to give us a couple more decimal places. So this is going to be the equivalent of being long 20 shares. So we would say there's two ways you can express delta. One is in terms of shares. And we used to do both, and we had different reasons for doing it. So I'll just quickly explain. So you like to think about things in terms of share deltas so that you can hedge with the underlying stock. So if I always want to be delta neutral, I know, okay, well, I have to sell 20 shares per contract. So if I had 5 lots on it, I'd have to sell a round lot, 100 shares to flatten myself out. But you also want to think about things notionally. And the reason you want to think about things notionally is because if you have a whole portfolio of stocks, 30, 40 stocks in your portfolio, if you have one stock that's $500 and one stock that is 50, and you're long 100 deltas in each, that's a very different thing. One's 10 times the size of the other. And so thinking about things notionally can just give you a better sense of where your whole portfolio is, because that's additive. Now, you might want to adjust that even further because some stocks are higher beta, some are lower. So you might, some people will do that on a beta basis and things like that, ways to normalize it. But this is just something I thought that might be useful for everybody to think about. And also, I thought it was a good example of how these things work. And you could actually see this in illustrating, in illustration of these things. So one thing I'm going to do here, go this other way. Now, I'm going to ditch yesterday's term structure. First of all, that's yesterday's news. Nobody cares. It's come and gone. Because I want you to take a look at something else as I do this. And I'm seeing that you guys like dark is easier on the eyes. Let's see. So I had a dark one here. And by the way, I don't know. So I'm logged into 2 instances. I don't know. I'm not having done this. We're about to find out. Okay, so it's I actually have to go back and change the configuration. Maybe you guys can actually bear with me for today. I'll put it into dark in the future. So here we go. I don't want to get too lost with fiddling around with. Whoops. Let's see. Okay, I'm blowing this up in a really clumsy way. I apologize for that. So as we look at the term structure right now, I want you to observe something else. Now, the nice thing about this illustration, hopefully for all of you, is that because they color-coded this, you can actually see where the volatility term structure is upward sloping, We call that contango. So what that means is that the longer dated expiry is trading at a higher implied volatility than the nearer dated one is. We can see that that's true here, which is actually just really short dated options. We can see that that's true here between April 17th and May 16th. And I'm just wondering whether anybody has any guesses as to why that would be the case. So you see this sort of there's kind of a metronomic regularity to where it becomes an upward sloping term structure and where it becomes a downward sloping one. What you're looking at are known catalysts. This one captures the next earnings, this one doesn't. This one captures the subsequent earnings, this one doesn't, and so on, right? So I've gone over this once before, but the beauty of this, if you don't know, I think at the beginning of it, I'm not sure if it was last year, because last year was a leap year, and I mentioned this on several live streams, that there were a lot of services that would provide information about when earnings were going to take place. And a lot of them were wrong. So you would look at it and you say, oh, when's earnings? And the dates would come up and they were not correct. And part of that was because a lot of those services basically take a look at when earnings has happened historically, and then they just do a quick calculation and then make an estimate based on that without accounting for the fact that there was an additional day in the year. And in many instances, what that would do, if a company reported on a Thursday, for example, after the leap year, it would push it, their automated calculation would push it into a Friday, and companies generally don't report on Fridays. So we knew there was something fishy. And the interesting thing about looking at the term structure of volatility in a case like this is that when you look at this, you get to see where the options market thinks those events take place. Now, where these prices are being determined is by the market making community, and they live or die by this stuff, right? So this is really important. As a market maker, I can tell you, you don't want to sell options that capture earnings too cheap, and you don't want to overpay for options that don't capture events. So it's really important from a market maker's point of view to get this stuff right. And generally speaking, the way it works, although it's many more now than it used to be. So, when I first started trading options on the floor, I was trading oil service options, and I was hedging with baskets of the constituent stocks of the oil service index. So I was really making markets in just one cash settled index and then trading a basket of stocks. So I didn't have too much stuff to think about. In really big products, so Intel at the time in the late 90s was one of the busiest single stocks. So, Microsoft and Intel, Dell, which was single listed on the PHLX. We had operations on the PICOS, the CBOE, the PHLX, and the AMEX. But in Dell and in Intel, where you could have over 100 market makers standing in the crowd. So you'd have a specialist post, you'd have all these specialists, and basically they would break these things down by expiration. And options traders were so specialized at that time that they might only trade Intel front month options or Intel leaps, or sort of focus on the middle of the term structure. And so too was it true for the specialists. So Spear Leeds was the specialist on the Amex for Intel, and they had, one team that handled one sort of group of expirations and another team that was handling something completely different. And the market makers in the crowd aligned themselves with those respective sections of the post. Nowadays, everything's much more automated. A single market maker might be sitting at a desk with 20 screens, I'm not joking, around them, and they could be making markets in 20, 30, 40 plus stocks. But even if it is 40, it's just those 40 that you have to focus on. So if you can imagine that you make your whole living making markets and options on 40 different stocks, you're going to be pretty careful about when the events take place in those 40. And if you have somebody helping you out, you can kind of pay attention to that sort of thing. Something else that's kind of interesting here, and I think I mentioned this but hadn't shown it. Check this out. So we had been talking, I believe it was about NVDA, and I was commenting that the implied move, that the stock had not violated the implied move very often. So what I mean by that is that whatever the options market had been implying, it generally, the post-earnings move was inside of that number. But take a look at AMD, right? So this gray bar represents the implied move 8 quarters ago. And you can see it moved more than that. 7 quarters ago, and it moved more than that. 6 quarters ago, moved more than that. Now, here it was inside, right? So this is Q4 2023. But the next one, it was outside again. This one, it was inside, but just. This one, it was outside again. And this one, it was inside again, but just. So I thought this was a really kind of a slick visualization tool. You can take a look at it in 4 quarters or 12 quarters or whatever. I think that's pretty handy. And then you can also see, this is actually, you guys have seen something that looks a lot like this one, I believe, because this is very similar, this table. This is much more like how it is reflected in the Bloomberg terminal. So we can take a look here. And so here are all of the respective quarters. This was the price move. Now, Bloomberg, interestingly enough, doesn't provide the historical implied move, which you are getting here. So this is telling you what the historical range was and how much the move was. On that table in the Bloomberg terminal, all they're doing is basically showing you what the historical move was. You can still calculate it. And the way you do that is, gets a little bit mathier and kind of clunky. So, this, let's see, I'm just putting something on the table here. Is this one feeding? Well, it's not really that important. So I created my own spreadsheet that just pulls data in, and basically what I'm doing is I'm getting different historical implied volatility, so different points on the term structure back in time, so as of certain dates, and then solving for what the implied move was historically. Okay, so all right. Now I'm going to take a couple questions here. So not very clear. I will be sure to switch this to dark, and I might be able to do that in just a second. We'll see. Oh yeah, it is. Well, I'm assuming that when you say it's not very clear, you're thinking that you'd probably prefer it to be in a dark mode, and I'll try flipping that over. So, Bob, I think Uber results were good to strong, and leadership and roadmap is strong. Market reaction seemed overdone. What do you see as next support level for Uber at next post-quarterly earnings release? You are long the May calls. Okay, well, let's take a look at that. A couple different approaches, I suppose, that we could take a look at. So first of all, where is did I bang out my, what did I do with my options play? So we're going to look at this a couple different ways. And then one of the things we're going to do is we're actually going to look at that backtester function in Bloomberg as well, just to see what several of those default and better performing technical analysis solutions were saying. So for Uber, we could even go through that same exercise. I don't know that it's important to go through the same exercise, which is, take a look at, say, a short strangle and figure out, whether it would have been profitable or not. But my guess is it probably would have been. So we can actually go into Uber here. We're going to go through the same exercise and see how did this one do. So this was right on the very edge of the implied move. As you can see here, it's outside, but it's close. My guess is that if you had traded something like a strangle swap, so that would be long, a longer dated strangle, short, call it a 40 some odd day one, or just short that strangle, you probably would have done just fine. We could model it if it's important to anybody, but I don't know that it is necessarily. So here we have a bullish signal. And let's see what we got in here. Apologize for the speediness or lack thereof. So pretty mixed bag, depending on which metric you choose. So we have quite an assortment, 20 different technical indicators here. What I have done is I've simply ranked these by the most profitable technical indicators for this security over the course of the last year. And I don't know whether the last year is the right way to think about it. Maybe we can go back 2 years. Yeah, I mean, it's pretty much split evenly, it looks to me. But, okay, so you feel like it's overdone. Let's just take a look at, these results. You know what, I didn't see, let's take a look at what the street was expecting versus what was reported. So we got 321 in the comp estimate. So yeah, I wonder why. Why was it quite so hard hit? What was it that everybody was so unhappy about? So they they had a slight miss, but the booking numbers were decent. So EBITDA 1. Okay, so it's a narrow miss, but it's a miss. It depends sometimes on the sentiment of the market generally, whether the street was. The consensus estimate for EBITDA was 1.85 billion, and they came in at 1.84. So that's a pretty narrow miss on EBITDA. The operating income for the quarter of 770 million, that was a much bigger miss because the street's estimate was 1.2 billion. And that will tend to change things quite a lot, right? So you're talking about a nearly $500 million quarterly miss, right? Is that what it was? Yeah. This must be an adjusted number. I have $620 million in adjusted income. So, but that, that really does change the multiple quite significantly. They had a net income margin of about 11.7% in the preceding quarter ended September 30th. So 5.2%. I mean, that's half, right? I can see why that would be vaguely disappointing. But with May calls, owning May calls, that's the good news is that, well, two things. Number one, you will capture the next quarterly earnings release, which right now is estimated for the 8th of May. The nice thing about that is that the vol crush is generally not going to be as profound. If you're longer dated options, you're going to be in that steeper part of the curve. And let's take a look here. I'm going to go to vol. And I'll bring this back down. So, here we are. Wait, did you say you owned May options in Uber? June. I don't think they have. Do they have a May regular way expiration? Or were you just referring to... Yeah, they don't actually have May. It's June regular way. So that's what... And this is what I was showing before, right? So you can see that it's going to be in there. Maybe... I'm sorry. You were probably just referring to when earnings take place. But that's one of those benefits, right? So here's something else that's important to remember. And that is that these options are not going to slide down the term structure as time passes. So as we migrate forward towards May, those options are actually, the implied volatility is most likely simply going to continue to rise because they capture that event. So the important thing to remember, though, is because of this, that when earnings comes and then goes, that vol crush that we were just illustrating in AMD, this is going to be true for almost any name that has bigger implied moves, and Uber qualifies. So if you're looking at something like Constellation Brands or JP Morgan, JP Morgan's a stock that doesn't typically move very much on on earnings. Consequently, the options don't price in a big move, so the vol crush effect is not that profound. But in a name like Uber or AMD or NVDA, names that are going to be moving in the high single digit, maybe sometimes low double digit timeframes, magnitudes, you're going to start seeing a lot more vol crush. So the important thing for you to remember is that as, number one, May 8th is the current estimate, but keep an eye on that. So you want to monitor that fairly closely because you may want to do something before earnings. A couple things you could do, right? So you can spread it. So convert your calls into a call spread risky. You could roll them out in time. You may even think about, depending on where the stock is at the time, you may even want to contemplate being short those options to be long something that actually captures subsequent events and try to capitalize on the vol crush. Whether you do or don't is possibly going to depend on something like this. So if you're looking at this left pane, what this is telling you is how expensive options are relative to their history. So some people look at vol percentile. This was something I think I brought up on Monday as well, or IB rank, but it basically just gives you a sense of where options premiums are in their own history. Now, different systems will give you different windows of time as to how far back you can go. And by the way, you can definitely see the seasonal effect that earnings has on options prices here, right? So, and this is what's going to happen, right? What's going to happen is these options, as time, as earnings approaches, you're going to get this big spike in implied volatility. And that spike in implied volatility, it's a funny thing. It's not that those options are going to go up in value in terms of their absolute price. It's just that what's going to happen is the price is going to get to a certain level, and then it's going to essentially stabilize there. Implied volatility will rise, and time will pass, and the value of the straddle, all else equal, will remain largely unchanged because it's priced to deal with that event rather than just the volatility that the stock is experiencing day to day. Okay. All right. So that is that for Uber. Hope that helps. Let's see. So Stephen says, please explain term structure. This is what we've just been talking about. And actually, there's something else here that I think is kind of important to think about too, because one of the things I was talking about was the relative price of calls and puts. The term structure tells you how expensive options are for different maturities, for different amounts of time to expiration. And that's what's reflected on the x-axis here. This is 30 days away, 60, 80, and so on. The other relationship that it's worth keeping an eye on is the relationship of out-of-the-money puts to at-the-money options to out-of-the-money calls. And the shape of those differences in implied volatility create something that looks like this. So the at-the-money options will tend to be lowest, and then the wings, as we call them, the out-of-the-money options, the further out you go, those will tend to have a higher implied volatility for most equities and for most indices. It is also common for downside in equities, for downside puts to trade at a premium to upside calls. This is something you'll really see exhibited probably a little bit better in something like SPY. Right, so I'm going to put SPY in or SPX or NDX. So notice the downside puts are much more expensive. The upside calls are less. Now, I encourage people to look at this because it just gives you a sense. There's some fundamental reasons why this is true. So, for one thing, just in terms of flow, SPY, SPX, NDX, IWM, diamonds, all of these things as index products are commonly used to hedge. And so if you own a lot of stocks and you think that the S&P is a good proxy and you want to use that as a hedge, you might buy puts on SPX or buy puts on SPY or something similar to that. And so that creates a demand to buy puts in the index. Now, there may be less demand in these indexy type products than there are proxies to buy upside calls as there is in single stocks. So that can account for this dynamic. Just a simple supply demand. There's a demand for insurance. And that insurance is usually overpriced. We refer to that as the volatility risk premium. Some people refer to it that way. There's another thing that's going on here. This is going to get a little wonkier, so I'm not going to get too deeply into it right now. And one of the reasons I'm not going to get into it too deeply right now is because we're going to be joined by somebody from Options Metric on Friday. We're going to get into this a little bit more. But when I first started in this business, I mentioned that I was trading the oil service index. So the oil service index it's a small index. It only had a handful of stocks in it. I think there was like 15, 16 stocks in it at the time that I was trading it. But you're trading a basket of stocks, right? And there's really three principal things that impact the volatility of that basket of stocks. One, of course, is the volatility of the stocks that are in that basket, right? All else equal, the more volatile those stocks are, the more volatile the basket of stocks will be. There's something else that matters: how much they're correlated. Stocks that are not at all correlated, you might have very high volatility individually, but if they're not correlated to each other, the net effect may smooth out a lot of that volatility, so the volatility of the index will be smaller. And the best example I can provide, you have two stocks that are perfectly anti-correlated, meaning that for one going up 1%, the other goes down 1%. By definition, a basket containing only those two stocks, assuming they're equal weighted, which is the third thing that matters, which is their respective weights in the basket. But if you have two equal weighted stocks that are perfectly anti-correlated, then it doesn't really matter how volatile they are because their moves are going to perfectly offset one another, right? So those are the three things. So why do I bring this up? Because one of the things that happens in a rapidly declining market is that correlation tends to rise. So if correlation goes up, what happens to the volatility of a basket of securities, all else equal? Its volatility will rise. So that's another reason why you would end up with an impact like this. So that helps account for skew. Now, there's some other things too that are kind of important. We're not going to, again, we're going to talk, that's what we're talking about there is dispersion and correlation. And we've got Gareth coming on from Options Metrics on Friday, and he's going to talk about that. I'll be very interested to hear what he has to say. Obviously, I traded that stuff myself. We started by trading, the sector indices. So the other thing that we talk about sometimes when we look at the shape of volatility is kurtosis. So that's another moment. The moments are basically the terms we use to describe how the distribution for returns in an asset differ from a normal distribution. So this, for example, this orange curve that you're looking here is a normal distribution, and this histogram reflects how SPY has actually behaved in history. And you can see that there's a big gap in here, this big open space, and there's a big gap in here, and you can see that there's more events out at the tails here, less so on the top side, but more on the downside, and that's kind of goes to that skew thing too. And you have more events in the middle. So a distribution that takes on this kind of shape for people who want to use statistical terms, this is a leptokurtic, right? So kurtosis describes basically how fat-tailed or not the distribution is, how concentrated around the mean it is or isn't. And then the skewness basically will be the asymmetry, right? So those are sort of the critical things to think about. And we're going to talk about that a little bit more when we discuss dispersion on Friday. Okay. All right. Could you please explain how we can benefit from unusual whales before committing to... I'm assuming you mean committing to buying it. The reason I'm showing it is because there's a couple things that I've been asked. Oh, the Bloomberg terminal has all these cool things, and how do I get that? And I have a certain, there's a lot of things I like to look at with great regularity. Obviously, I want to take a look at volatility. I want to see what the term structure looks like. I want to know what the volatility surface looks like. I want to know when earnings are going to come up. I want to know how much it has moved over the course of time historically. I want to see what analysts, so this is the vol surface for SPY, for example. Moneyness is not the way I prefer to look at it. Delta and sigma is usually the way that most options traders will look at it. I want to know when things like earnings are coming up. This is all value. How do you trade without having these things? Well, you can't really. But the Bloomberg is, I think it's a year contract minimum, and it's $3,000 a month minimum, right? So the question isn't, to me, isn't so much, can you explain how you benefit? I mean, you have to decide. Everybody's going to have different, they're going to have different inputs that impact how they decide what they're going to do or not do when it comes to trading. If you don't care about some of this information, I'll give you an example, right? So there are traders who look only at short-term charts and day trade throughout the day and don't ride positions overnight. I actually know somebody who's been doing this, and it's quite amazing. So his wife and my wife are friends. They knew each other when they were in college in Southern California, and her friend married a local contractor. He was a commercial contractor. He built restaurants and malls and things like this. And he ended up having he's an exceptionally good golfer. Tried out for the U.S. Open not that long ago. In any case, but then he ended up doing something to his back, and so he wasn't going to work, and he started day trading. And he never consulted me about it. He has some proprietary approach, probably something he picked up on the internet. And the guy's making like $1,500 a day doing it. And he does not know what stocks he's trading. He's not paying attention to things like earnings. He doesn't pay attention to economic stuff. He's only looking at real-time charts. And consequently, because of that, he doesn't need a whole lot of additional information. But there are a lot of people who are not interested in trading if they can't see what's going on. They are not interested in, well, let's just take a look, right? So, and actually I'm using the Bloomberg terminal. Let me see, I just lost my, yeah. So, you want to know what stocks have earnings coming up. I mean, I just hit it with two buttons. Maybe that matters to you, maybe it doesn't. I'm not going to be the one to tell you. You want to know when, what's coming up on the economic calendar, because that is the kind of thing that moves markets. If you ride positions overnight, you usually want to know about the things that could potentially move the underlying. Maybe you care about what other institutional market participants are doing. So you want to see big flow. Maybe you want to be able to drill down on that flow. But maybe you don't, so I can't really tell you that. And maybe one of the reasons you're watching this right now is you're just trying to say, okay, well, I don't trade options yet, or maybe I don't even trade stocks yet, and I just want to hear what, I saw this guy Mike on TV, and he was a professional trader for a lot of years, so maybe I want to hear what he has to say, and I'm trying to figure out whether I want to do this. Well, I'm not going to tell people that aren't doing this, go run out and buy this technology and that technology and spend money willy-nilly, hoping that it's going to, give you some magic answer, because that's not the case. But what I am saying is that if you're trying to look at the same information that I do, and you don't want to spend, $40,000 a year, $50,000 a year if you get real-time data on a Bloomberg terminal, and why would you, right? So that that's a monthly. That's what, a Ferrari. So you could always be leasing a brand new Bentley. That's one way to think about it, for the price of a Bloomberg terminal. So if you want a lot of that same information, but you want to say spend as much as you do on a cell phone instead of a Bentley, maybe there are some places to get it. This is one of the ones that I came across and I kind of like. I actually don't know. I'm trying to think. I'm not sure that I know another application that is quite as feature rich on the options side for data as this. I can't think of one. I'm always looking around for new technology, so I'm always very interested to see what people come up with. And it's an interesting thing too, because I always thought that one of the better platforms, and I'm not making a recommendation, whatever platform you're on, if you're happy with it, don't switch because of what I'm about to say. But I've used Interactive Brokers platform for a long time, and one of the reasons I did that was because we used it as I mentioned this before. It was one of the backups that we would use when I was at Cantor Fitzgerald, when I was at CRT Capital, in the event that our own exchange connections and pipes went down. So, banks, professional trading firms, either have their own trading technology, or, which was true when I was at Gateway and Bluefin, and sometimes they'll buy, products that are designed for institutions for trade order management. So, for example, at Cantor and at CRT, we use a system called Fidessa. Doesn't matter. That's not for you guys. Okay, it's an institutional thing. Very expensive, and there's not any real benefit for a retail trader to use it. It's not like it has some special superpowered gizmo or widget that will help you generate additional profits. It was designed for very specific compliance issues, for handling a lot of orders from a lot of different buckets, internal and external. So unless you're managing other people's orders, you don't need this kind of stuff. And also, you don't print to the tape. That's somebody else's job. We actually had to put the labels on the trades. So, there was a lot of things that were built into it. So my point is that the stuff that we use generally to get this kind of information was often wrapped in technology that was designed for a lot of things. And so it wasn't that often that I would find that the kinds of feature sets that we became used to were available in a retail platform. And it's only more recently that those things are offered on a completely standalone basis. So independent of whether you use Interactive Brokers, which had a lot of features built in because it was built by traders for traders, Petterfee was also an options trader. He was a floor guy originally as well. He built a proprietary trading firm that we competed with called Timber Hill. He was obviously a lot more successful at it than we were, because he's worth whatever, $40 billion. I'm not. And he got completely onto the brokerage side of the business, and maybe that would have been the right way to go. But my point is that there's now a lot of very good technology. And actually, when you log onto this thing, you get a change log because they're constantly evolving it. So you can always see what new things they have. So anyway, that's enough of a rabbit hole I've gone down there. You can decide for yourself whether it's appropriate. James, can you provide insight on Amazon and tomorrow's earnings? Well, yeah. So, first thing first, why don't we just hop in here and take a look at its history. So we can see, right, you can visualize the implied move right here, slightly over 5%. What is interesting to me is that, remember what I was saying, you know, I think it was NVIDIA. Was it NVIDIA? Or was it Tesla? It wasn't this one. Maybe someone can remind me. Whatever stock I was looking at on, I think it was Monday. But it was one of these situations where the options market was almost always overstating what the implied move was. But in Amazon's case, not so much, right? So the last one, that was outside of the implied move. The one before that, outside the implied move. It didn't move that much the time before. It was up just about 2% and change. But the 3 prior quarters, bigger moves. So if this is at all representative, the first thing I would say is options look very reasonably priced. I would not... Here's one way to think about this. When you see a red X, that's when you didn't really want to be short the straddle going into the move, right? Because if you were short the at-the-money straddle and you get a little red X there, that's when you lost. And I see 3 green dots and all the rest are red X's. So, and the implied move right now, interestingly, is not, it's not like it's larger than it usually is. In fact, it looks like it's just about average, right? So if you go back here, it's about the same as going back to the first quarter of 2022. You've had some instances actually where the implied moves were larger. One important point that I think is actually well worth mentioning, and that is that there can be a seasonal effect. Some earnings seasons will have a bigger move on average than other ones will, because the business itself has a lot of their earnings or revenues packed into a given quarter. Now, in Amazon's case, you might normally suspect that that would be true. So if they didn't have all of their other businesses, like AWS, which is obviously hugely important, things like that, you might look at this and say, well, of course, the last quarter of the year is going to be really important because that's the holiday shopping season. But of course, Amazon now, you know, they've got a massive cloud business and things like that. So it's not going to be quite the same in that respect. But, you know, take a look. Is it a coincidence that it was 4 quarters ago, which was when they reported in the first quarter of 2024, that move, both the implied move and the, you know, was bigger? You know, maybe not. We don't see that this time, right? So I will say this, you know, it's interesting. Amazon they do seem to be, first of all, they're in some critical and secular growth businesses, which is, you know, a real plus. The second thing is that a lot of people wondered for ages whether or not the company was ultimately going to be profitable. Everybody used to trade this thing or value it based on their turn to EBITDA. And the idea was that the company was basically taking all of its money and reinvesting in its own growth, but that they didn't have a lot of margin and they didn't have, you know, a lot of free cash flow, and that had some investors concerned. But the bulls on the company for the longest time were saying, no, it's just a matter of time. It's a lever that they can flip. And for the naysayers, they sure got a little bit of a comeuppance because indeed they could flip it, and indeed they did. So now you're looking at a company that is generating massive amounts of free cash flow. That doesn't mean you're getting it hugely cheap either, right? So the stock's $2.5 trillion at this point. But, and what does that work out to as a forward free cash flow yield? I'm just going to round that up and call it 65 and 2.5. So 2.6% free cash flow yield with anticipated growth of, I'll call that 44.5. Oh, jeez. More than 40% year-on-year anticipated free cash flow growth. Yeah, that's not too bad. Okay, so let's just take a look here. We'll quickly review what some of the technical indicators have to say about this thing. And we can see that most technical indicators are positive. There's a handful here that are not, but in general they are positive. And go back a little bit in time. Actually, you know what I'd like to do here? See how orderly this is over a longer period. All right, so now we're just looking at a really long-term logarithmic chart. And so the reason I wanted to look at this, and I'm going to show you something else. I wish, unfortunately, what I would want to do is I'd prefer to show you this without actually telling you what you're going to see me typing in what this is. Oops, no, not GPC. That's not what I wanted. But I thought this was kind of interesting, and I've seen this chart flashed about quite a lot. So I'll let you guys can make your own judgments. I'm not drawing the lines, as my friend Carter Worth would often say. I'm just going to let you guys, be the judge yourselves. So that's a logarithmic chart of the S&P going back a century. And like I say, I mean, you could say, oh, the lines draw themselves. I don't know. I mean, it's interesting. How about we put it like that, right? So that's the bubble in 29. That's the tech bubble. And this is today. Make up your own mind whether you think that's important or not, but it's interesting, right? And a little unnerving, I would say. Okay, so Amazon, the move is not, the implied move is not excessive given the company's history. So it would not be my favorite idea to, for example, sell really short dated calls. Does that mean that you couldn't sell a 20 delta strangle? Actually, that's probably okay, because the interesting thing is that when you sell that strangle, one of the things that's going to happen is you have the benefit of the vol crush and the passage of time, but you don't have as much gamma. You're not short as much gamma, so that your delta doesn't change as much. You're not going to get whipsawed. To put things in perspective, let's think about this a different way. If you're going to sell a 20 delta strangle that expires at the end of this week, let's just see which one that is. So the 20 delta puts are, we'll call it, it's somewhere in here. It's going to be the 220s or the 222.5s, and the 20 delta calls are going to be, 252, 255-ish. Okay, so we're going to try to be delta neutral exactly. We'll take these 222 delta options, for example. That's going to be the 252.5s and the 222.5s. Okay, so the $30 apart. Basically, you're going to be touching your strikes on a $15 move in the stock. So, and that makes sense, right? The 20 delta options are going to be about the implied move away. If you go further out in time, kind of what we were looking at in that AMD example, so let's just use March because we were using March before, that's fine, right? So now you're looking at the 215s on the downside. And on the upside, you're going to be looking at the 265s. So that's closer to a $30 move to the upside to that 20 delta call. And it's, a $21 move to the downside on that 20 delta put. So that's a delta neutral trade. So it's not going to blow through your short strikes, and then you're going to have vol come in and things like that. So that would be something you could do. Something else you could do if you just wanted to be long and strong going into the print. I'm going to do two different setups here. So the first one I'm going to do is all you're interested in is playing the move itself. So like I said, you could buy the call because the options are reasonably priced. So that would be, doesn't matter. We're just going to get close. Oops, what did I do here? Didn't mean it went down too far. So you're going to risk $7.40. So, 3.5%-ish of the current stock price on an upside bet. You could spread that a little bit, which I think is fine. And actually what wouldn't probably be a bad bet would be to take something that's maybe very slightly in the money, like these 235s, and then, get short something out to the implied move to the upside. So that's going to be like your 250s, like this. You're going to get something like that. Okay, so that's just to play the move. So that's one trade, and I'm suggesting that simply because we just went through that whole exercise in here, and we saw that the options are reasonably priced going into the print. So for a debit trade, that's fine. We outlined the short 20 delta strangle, and we saw that actually is probably going to be fine as well. I don't so DJ, on selling Amazon call, remember if they beat cloud, I don't like, if you're long the stock, I don't like doing a buy right or a covered call here. There's been a lot of research done. Just selling short dated calls going into earnings, isn't a hugely profitable strategy. I'd much rather see you sell lower implied vols between events than just sell calls going into it. So I don't know if that's what DJ was referring to here. All I'm talking about is that if you're looking to mitigate the expense, shoot out to the implied move or beyond on the short leg, right? And if you're looking at that strangle, so don't forget that another thing you can do is try to get out to the next earnings event and do something like a strangle swap. We've talked about those. Now, because I was just looking at March, now normally with the strangle swaps, I was generally speaking looking at, so we're just going to put in a put here. So we'll just go to the 20 delta put, which I was looking at before, 215s, and it was the 265. So we are selling those. And then you want to capture the subsequent earnings event so that you're not going to get the same vol crush. And just to be safe, when is their next earnings? That's probably going to be so May will capture it. You could probably trade the Mays on this side. And you could do that as a straight calendar. So straight calendar just means that you're matching the strikes of the ones that you're selling. I don't always do that, by the way. And you get a structure that looks a little bit like this. Now, notice that this middle section is basically a break even. Why is that? Well, one of the reasons it's a break even, rather than getting sort of, the valley being higher than break even, the reason is because the front month options just aren't that expensive. So if the implied move was much higher than it is, so maybe had an 8 or 9% implied move, what this would actually look like is a situation where these peaks would not only be higher, but you'd probably make money anywhere in this region, right? And what this and actually, the other important point I would make is that there's no vol crush baked into those longer dated Mays in this structure right here. And there will be some. It's not going to be huge because you still capture the subsequent earnings event, and there's a lot of other things that are going to keep that volatility elevated. But it will come out because there is some premium that is baked into everything in the term structure, however far out you go, and its impact as it pulls out is going to be more and more muted for the upcoming earnings, right? So this is a trade structure I usually do like. Not as crazy about it here, simply because, you win here, you win there. I kind of like it when you get into a situation where the expectation is you're going to be profitable everywhere in the middle. Okay. So what is our timing? Ooh, we've gone over an hour already. Looks like we've gone way over. That's how much fun I have. Yeah, let me just quickly grab this short strangle question. Where is it? We had a question on NVDA. Oh, sorry. Oh, man. An NVIDIA question. We got an NVIDIA question right in the beginning. I would have jumped all over that. You discussed a 20 delta short strangle on NVIDIA into March in terms of an exit. Do you exit when one leg reaches 60 delta, or do you have another discipline to share? Okay. So different people have different approaches to this. I always look at adjusting an option long or short when the delta gets, it's kind of a trigger no matter what. If it gets to 60 delta, I start to look at it, and the reason is because that's an option that's most likely going to end up in the money. So it just deserves some investigation. But I want to point out that for those folks that are looking at other approaches, so for example, those that have suggested, oh, sell a 20 delta straddle. Let's put this in so we can have it as an example. What do you do if it goes... Well, actually, I'm not even going to say it goes against you. If it just goes. What I mean is that the stock is simply going to start moving, right? It's not likely going to stay absolutely. So I'm just going to switch one to a call. We're going to put this in just theoretically. Choose a 20 delta call. 154s and a 20 delta put, which in this case is 106, 108. Why are we missing a strike in here? Must be dealing with a... So this is actually an important point. When we're doing these live streams and it's after hours, there's a chance that there's, a thin market, and that's going to impact things. So what can happen here? So if the stock goes down after the event, well, there's a couple things going on. One is you're now going to have a short upside. Let's say it goes down, right? Runs towards the strike, the downside put strike. Well, a couple things are going on. Vol will have come in. We know that because the event's going to come and gone unless there's some... I can't imagine what wild announcement would be made where it would not decline materially. So that's the first thing. The second thing is that this upside call, you're going to have moved further away. So for delta reasons, for decay reasons, and for vol crush reasons, that short call is going to have decayed in value quite considerably. But now your deltas are going to be out of whack because you have migrated towards that short put. So those deltas are going up. And the call is not going to have that much delta left. So it's not much of an offset. So what can you do? Well, you could move your short lower strike down, buy that short put, and sell a further out of the money one. But think about what's happening there. If you do that, you are laying premium out. This is a short premium trade. So you're going to spend money to buy the close put back and collect less to sell one that's further out of the money to true up your deltas. How does that sound like that's going to work out? Probably not that great. Well, what's something else we know? The reason vol has come in is because an event has come and gone. The market's not expecting the stock to be as volatile. So as long as that downside put isn't, materially in the money, it's not like a 60 delta option or something. And by the way, if that happened, a perfectly acceptable next step would be to say, you know what? It moved way more than I expected it to. I'm going to put this one to bed. But if it doesn't, if it just moves down and your deltas are out of whack, you could cover the short leg on the call side and roll down and true up your deltas this way. Or move them both down, right? So that you're not laying out premium. Maybe you collect a little bit of premium, but true them up this way. The reason for this is because the thing that was going to move the stock has come and gone. It's not going to be as volatile. So the 20 delta strangle is going to be a different strangle, frankly. So that's a way that you could very seriously consider adjusting that strategy. So we're going to have an opportunity. I mean, we actually have some more time to talk about that in future episodes because they report on the 26th, I think. So I'll try to model some things up, and then we can sort of walk through what if scenarios. You know, put this trade on. What if it goes down here? What if it goes up there? What if it stays put? Stuff like that. But those are the two things to think about. But for sure, if you're in an option, long or short, and it gets to 60 delta, let's say you picked it up at 30 on the long side, well, it's a very different risk-reward relationship at 60. And that means something has happened. And you need to evaluate that. It doesn't mean if you're buying a call at 30 delta, it's now 60, that you're not still bullish on the stock. You can be. But that option is going to behave more and more like stock and less like an option. And those are important considerations. And I think we can probably wrap it up there since I have chewed up an hour and 15 minutes of your valuable day. And I appreciate it for those of you guys who stuck around and listened to all of this. And I'll switch everything to dark theme going forward if you guys like that better. And hopefully that'll make things a little bit easier to look at. So until next time, thank you very much for watching. Tune in on Friday if you're interested in dispersion trading, because that's what we're going to be talking about with the guys from Options Metrics. Thanks for watching.